Keeping your money in the bank account is not necessarily the best idea. Investing it in instruments like liquid funds will definitely get you better returns. Hello and Namaste Paycheck Pros. I'm Manish Ahuja and this is Paycheck to Profit, India's first YouTube channel dedicated to your financial freedom. In this channel, we talk to you about how to manage your money, how to make the best out of your paycheck, how to invest your money using your paycheck so that it can lead you to your financial freedom. One of the main mottos of Paycheck to Profit is earn your financial freedom through your paycheck. So we try our best to help you with these videos where we introduce just one or two topics to you in every video that helps you understand your investments a little better. Taking that streak ahead, in the last few videos on this channel, we've been talking to you about mutual funds. What exactly are mutual funds? What exactly are mutual fund houses? How to invest in mutual funds? How do mutual funds invest on investors' behalf? What kind of returns can you expect out of mutual funds? What are SIPs? I have covered all of these questions in the last few videos. If you haven't seen all of those earlier videos, I would request you to please check the description of this video where you'll find all the links necessary to all our past mutual fund related videos. If you haven't subscribed to this channel, this would be a good time to pause the video and subscribe to the channel. Please do not forget to press the bell icon because I create new videos on 4th, 14th and 24th of every month. I make sure to create these videos both in English and Hindi so that you can choose the video as per your language preference and you get the same content in language of your choice. In today's video, I'm going to talk to you about a very simple category of mutual funds, also one of the most basic, which is called liquid funds. As the name suggests, liquid in money terms is considered to be liquid cash or liquid money, which is very easy for you to withdraw and take care of and transfer from one account to another as and when needed. So taking that same idea ahead, mutual funds have a category called liquid funds where you can invest and you will definitely get better returns as compared to your savings account, and at the same time your money is not parked in a fund where you can't withdraw them as and when needed. Yes, they are not as flexible as a bank account. I'll explain to you how. Let's say you have 25,000 rupees in your savings account in your bank. You can swipe that 25,000 immediately. You can just withdraw that kind of money from the ATM, or you can just sign a check and give it to the vendor or a person of your choice and that check will fall through. In liquid funds, that's not necessarily the case. Although today there are very few liquid funds which allow you same day withdrawals, but that is not necessarily going to be the case for most mutual funds. What you need to understand is liquid funds generally have 1 to 1.5 or 2 days of turnaround time for you to withdraw those funds. So if you can manage your payments in such a way that you can manage your funds for a day or two, liquid funds is definitely one area that you must invest in. As an investor, when you invest in liquid funds, what the mutual fund house actually does is it collects and pools all the money from all the investors and invests this money in government bonds, securities, commercial papers, or bank bonds, which can range from 1 to 90 days of maturity. Maturity period of 1 to 90 days works tremendously well for the investor. The risk associated with the investment is reduced significantly because, let's say in case of a bank generally comes out with 1 day bond instruments. They do that to ensure that at the end of the day, the bank has enough necessary cash funds in their accounts so that they match up to all regulatory requirements as suggested by the RBI. A company can come out with a temporary bond of 1 to 90 days to fund a particular large order, an import order which they are getting, or to hedge some necessary raw material funds, or for n number of reasons. But when reputed companies give out these bonds, these bankers and mutual fund houses literally pick them up and grab them with both the hands because liquidity and the risk associated with these bonds is very, very, very low. As a result of which, when you as an investor invest in liquid bonds, your funds automatically are safe from almost all market factors. Obviously, it's a mutual fund. Obviously, it's the money that you're investing is being invested in a market related instrument. So there is limited risk, but especially in liquid funds, the risk associated is very little. Because you are investing your money in a liquid fund and not keeping it in your bank account, mutual funds make sure to give you a return which is higher than the interest that you would accumulate out of your savings in a savings account. Please make a mental note of one simple point. The returns that you accumulate out of your mutual funds are taxed as per your tax bracket, and there are some rules which you would rather not get into in this video. However, mutual funds are well aware of all these taxation rules, and they make sure that the investor gets much better returns as compared to the interest that they would accumulate in a bank account. As a result of which, I would request you to keep a very small amount as per your comfort level in your bank savings account, and all the rest of your savings should actually be invested in liquid funds if you are not investing them in other instruments like mutual funds which invest in equity and debt, or you're not investing directly in equities, or if you're not deriving any sort of a passive income out of some real estate investment, so on and so forth. So what I'm trying to tell you is, the small amount that you have in your bank account is your savings, and everything else, your buffer funds or your household expenses fund, which we've discussed in one of our earlier videos, should ideally be invested in liquid funds to ensure that you get higher returns as compared to your bank account. So Paycheck Bros, I hope you've understood the impact and advantages of liquid funds. I hope you've connected the dots and you've realized that keeping your money in the bank account is not necessarily the best idea, and investing it in instruments like liquid funds will definitely get you better returns. I hope you derived some value out of this video and you've learned something about liquid funds, and you will hopefully start investing your money in liquid funds. If you like the video, please do not forget to hit the like button. Please share this video on other social media channels so that your friends and all your social media contacts can get to know about Paycheck to Profit and help this channel grow. So that's about it from my end. I'll now see you in the next video. Until then, keep smiling, take care of your loved ones, and stay happy. Kaching!